Good morning, you're watching Businessworld Live. I'm Danny Laurel. It's 9:30 a.m. this Tuesday morning here in Metro Manila. We are entering another trading month, but first let's go straight to our top story. The Trade Department is bent on pushing for measures that would open up the economy to more foreign direct investments. This comes after the country's policies were deemed among the most restrictive in the world, as reflected by the OECD's 2019 FDI Regulatory Restrictiveness Index. The Philippines settled in fourth place among 84 economies in terms of FDI restrictions. Most prohibitions stem from the Constitution's 40% ownership cap in key industries such as telcos, real estate, agriculture, and utilities. Trade Secretary Mon Lopez says the country's dismal ranking should prompt lawmakers to urgently pass amendments to the Retail Trade Liberalization Act, or RTLA, and the nearly 9-decade-old Public Services Act, or PSA. Tweaks to the RTLA include the reduction of the required minimum paid-up capital for foreign firms seeking to enter the Philippine retail sector, while revisions to the PSA include the lifting of foreign ownership restrictions in certain industries. Lopez also pushes for the CREATE bill as well as improvement of the ease of doing business. The House of Representatives have already approved changes to the PSA and the RTLA, but its counterpart bills are pending at the Senate. Senate President Tito Soto says they will try to prioritize all economic-related legislation. Public Services Committee Chairman Senator Grace Poe earlier said PSA amendments would be tackled hopefully this year. That's as the Congress focused more on the COVID-19 response bills. And speaking of COVID-19, President Rodrigo Duterte extended the general community quarantine scheme for Metro Manila until September 30. Okay, I'm gonna kick off by breaking some manufacturing news here. You can see on my terminal, the Market Philippines Manufacturing Index, or the PMI, hitting 47.3. That's for the month of August. This is a dip from the 48.4 print we had seen in July. Now, this basically means that less than 50, of course, is a reading that signals a contraction over the previous month, which had already seen a contraction. You can see here this V-shaped dip wherein we dropped into our lowest levels in a very long time. We actually now have the lowest reading since May of 2020. Last year, during the exact same month of August, we were at 51.9, so still expanding over the month before. Now, our output fell to 43.7 versus 48 in July. That's the lowest reading again since May 2020. New orders also fell versus the prior month. Now, I had taken a quick peek versus the other countries over in Asia. China still has no PMI released as of yet, and neither has India for the month of August. But for the month of July, you did see China's PMI at 52.8. Now, I'm looking at my chart here, and you can also see other countries such as Indonesia, Japan, Malaysia. Apart from Malaysia, Myanmar and South Korea all having at least showing an improvement since the month of July. So the Philippines sitting out that improvement. Again, we have a contraction in terms of our manufacturing sector, and that contraction is even worse compared to last month. Now, let's take a quick peek at our local currency. Just as we open the markets here, that is a good sign because we can see it's strengthening even further. We are at 48.467 to the greenback. Now, you can see on my charts here how strong we've been in the past month. We've appreciated down by 1 4/10%. Now, this according to Bangko Sentral Governor Ben Diokno, the favorable investor sentiment over the country's sound macroeconomic fundamentals is expected to provide support to the peso. We are still at the strongest level in 4 years. Now, this despite the fact that we did see a 4.2% decline in remittances from the months of January to June, and even the inflows from our exports and tourism continue to suffer because of all of the mobility restrictions linked to the COVID-19 pandemic. He did, nevertheless, this the BSP chief, attributing the strength to our benign inflation environment as well and our resilient banking system. However, this from Bloomberg citing a Manila Bulletin article, the Philippine Chamber of Business and Industry is actually asking the government to review the peso's strength against the dollar because it does have an impact when the peso is weak to exports as well as agriculture. Now, let's take a quick peek at how markets all over the world are faring this morning, starting off with Wall Street and how that has pared back gains. Wall Street has actually been euphoric, hitting all-time highs for the S&P 500 and the NASDAQ over the past several weeks. That is slightly retreating, although the NASDAQ is still up by 0.7%. You've actually got this on the back of global stocks up by 6% year on year in the month of August. 10-year treasury yields almost 20 basis points higher. But even with this euphoria, you can see on my terminal here how not smooth sailing it's actually going to be. Asia is opening in the red with the Topix down by 0.6%. The Nikkei 225 as well suffering some losses here. Over in China and Hong Kong also opening on the back foot. Taiwan, however, and South Korea, I had mentioned South Korea seeing a better print in terms of their PMI up by 0.7%. Another thing I wanted to mention, this from Nella Richardson. She did mention on Bloomberg TV, she's a strategist at Edward Jones and Company. She says that there are three things driving the rally. There's the optimism on a vaccine, there's the longer interest rates that are lowering, and the third is a quicker than normal recovery in terms of earnings. She said that's what's making markets more optimistic. But as you can see in the first trading day of September, Asia not necessarily sharing in that optimism. Let's take a quick peek at how our own local index is faring compared to the rest of the region. Always going against the tide here. We are seeing ourselves strengthening. We're at 5904.61. That is up by 0.4%. Finally, a relief rally here after we had seen some pain last week. We had seen 5 straight weeks of losses. And finally, Phil Stocks' Claire Alviar saying that the market is expected to rebound because we have entered the Burr months. She said that usually the holiday season may signal improved consumer spending, backed by an expectation that the lockdown restrictions will be eased. So this amid, of course, the government announcing the extension of the GCQ until September 30. And she did mention we are hopeful, but still not as optimistic as before. But 2Trade Asia does warn, don't be so certain. The month of September may also signal volatility. There are increased climate change risks, of course, due to La Nina. You've got agriculture, tourism, and energy on the alert side when it comes to investors because of the fact of the La Nina having, impact on that. Another one, of course, that Phil Stocks had mentioned actually is that the PMI might be impacting the markets. But as we can see here, it's opening in the green despite the fact that the PMI is lower than we had seen compared to July. Let's take a quick peek at some sectors that we want to watch out for. Let's take a check on the property space. This, of course, is something that analysts are watching very closely today with the GCQ. You've got malls still on operational, but at a very limited, level compared to normal. And this, according to analysts, the property sector outlook remains still rather dim, as the shoppers will continue to be staying away from the malls. They did mention we may see double-digit profit drops for the rest of the year. These are according to AAA Equities and Phil Stocks Financial. There will be weaker mall traffic despite the easing of the lockdowns. Now, this, according to Chris Mangon of AAA, we are taking a very close look at mall traffic because it has a multiplier effect on the property companies, even as the earnings in the first half of the year, which did decline by 41% for the entire property space, was in line with their estimates. He did mention they're expecting earnings to improve quarter on quarter, but still lower than what we saw in the same period of 2019. Now, recall the property giants, Ayala Land, Robinsons, Mega World, SM Prime had all, except for SM Prime, had all slashed its capital expenditures. SM Prime maintaining the same compared to last year, but all companies had reported earnings declines. But you can see my property index index here up by 1.7% in this trading day. So probably one of the shining stars here. I did mention the biggest players. Ayala Land is surging right now, up by 2.4%. SM Prime up by 1.4%. We will ask our analyst Robbie Samson later on why that is and why they are surging amid the extension of the GCQ. And finally, let's take a quick peek on our airlines. This, as several analysts have said, that despite the fact that we are in the Burr months, it's usually the time where people travel, especially during Christmas, the holidays will not be bringing a lot of cheer to our airline companies. They will probably not be benefiting as usual due to the fact that even as travel restrictions are eased, there's still a lot of quarantine, still wary about the pandemic. Recall that we had reported earlier on, IATA had said that airlines are expecting a 55% decline in the air traffic. Now, this according to PhilStocks, the second half is still going to be challenging for the airlines, and the sales might not even exceed the first half figures. So they did mention, that the worst is still not yet over for these airlines. Now, this according to PhilStocks is Japet and Tianco. You can see on my screens here, Cebu Pacific actually surging by 3.4% this morning. And this, he said, that after it had actually fallen from peaking at 55 pesos on June 9. So the stock had neared its March 2020 low of 35 and could actually fall further. But we can see it going against the tide and actually enjoying a massive gain here at 3.3% compared to Friday's close. PAL shares had also been dropping. You can see it bearing back a touch. That's down by 0.02%. Meanwhile, Macro Asia is also down by close to 4%. Now, another one that I want to report on in terms of airlines is AirAsia. We have been watching that very closely because a lot had been excited that that would eventually IPO. They had these plans for several years now. They are now shelving anew those plans to go public. They said it's unlikely that this will be happening in the next 2 years. So this is according to their CEO, Ricky Isla, saying it's still unlikely next year, not 2021, even 2022. It will probably not happen. Let's be realistic. Everyone right now is incurring losses. So again, another IPO or fundraising shelved there. This as the airlines passengers plunged by 99% in the second quarter due to the pandemic. They ended the quarter at a 19% operational level compared to its pre-COVID capacity. Now, more on markets later on in the broadcast with First Metro Securities' Robbie Samson. Let's check in on the biggest headlines that we are watching this first trading day of September. HSBC sees a possible double-dip consumer recession for the country. That's after Metro Manila and the surrounding provinces were put under stricter lockdowns earlier in August. Now, according to a report by the Philippine Star, the British banking giant said prospects for the country's economic recovery in the third quarter has softened. The Philippines has implemented the longest and strictest lockdown in the region in an effort to curb rising infections, with total cases now past 220,000. HSBC sees the country's economy contracting by 11% in the third quarter and by 9.4% in the fourth quarter. Overall, the multinational bank sees Philippine GDP slumping by close to 9.6% this year. That's before making a rebound in 2021. Economic managers have presented a slightly less pessimistic outlook on GDP contraction this year, although the group slashed rebound projections for next year from their previous 8 to 9% target. HSBC said lockdowns are, quote, bad news for consumption-driven economies. Its chief economist, Joseph Incalcatera, also noted the collapse in investments in the first half, which he said resembled the dark days of the Asian financial crisis. The Philippines slipped in this year's ranking of outsourcing destinations. That's amid the effects of COVID-19 to the economy. The country ranked 6th in the top 50 digital nations of this year's Tolon's Global Innovation Index, that's slipping a notch from last year's 5th ranking. Topping this year's list is India, that's followed by the United States, Brazil, Canada, and the UK. Rounding the top 10 were Russia at 7th place, followed by Mexico, Vietnam, and Singapore. The index also features the top 100 super cities, wherein only two made it from the Philippines, and those are Manila, which dropped to 4th place from last year's 2nd place, and Cebu, which dropped to the 15th place from last year's 12th. Davao City, meanwhile, fell out of the rankings after holding the 95th spot last year. The report cited India and the Philippines as among the hardest hit, as their value proposition was, quote, heavily based on low-cost talent working out of offices offshore. Global strategic firm Tholon said the index ranks the most attractive global outsourcing destinations based on talent, skills and quality, the business catalyst, cost and infrastructure, risk and quality of life, and digitalization and innovation. Now, the budget department is expecting the two state pension funds, that's SSS and GSIS, as well as the public health insurer PhilHealth, to all incur budget deficits this year. Citing estimates from the Department of Finance, the DBM said the three agencies need to fill a combined budget gap of 84.8 billion pesos this year. That's equivalent to 0.4% of GDP. The three government-owned corporations are also seen to post deficits next year, but narrower at a combined total of 1.7 billion pesos. The Finance Department said deficits are expected. That's due to an expected drop in the cash position of SSS and PhilHealth. SSS in particular was gravely affected by the increase in releasing unemployment benefits. That's as more people are losing their jobs due to the pandemic. The cash position of PhilHealth is also seen to decline because of lower contributions and a substantial benefit payment for COVID-19 related cases. The three organizations generated a combined surplus of 54 billion pesos last year and 63 billion pesos in the year prior. It's the last quarter of a year we would rather forget, but if it is any consolations, the Burr months are usually beset with cheer and optimism. Do we have reason to believe that old habits will die hard? Here to share his views, we have with us Robbie Samson, Mindanao Business Development Section Head of First Metro Securities. Good morning, Robbie, and welcome to the broadcast.
Morning, Danny. Nice to see you again.
Thanks for being back with us and looking very healthy indeed. Now, Robbie, just
Thank you.
kicking off with how our markets opened. Are you surprised this general sentiment of positivity as we enter the Burr months, especially on the back of our PMI contracting, nevertheless, and even lower than July, and despite the fact that we are still in a general community quarantine, at least for Metro Manila, until the end of the month?
Well, I think it is indeed a confusing moment, no, when we see bad news coming out of the economy, but still the stock market is going up, and I think that has more to do with the fact that the stock market generally is a forward-looking mechanism, meaning they discount news as early as they can, and perhaps because the market is going up, that means that investors are looking more toward the future. So they see that we're already past, they've already accepted everything there is to accept about what happened during the lockdowns, during the pandemic. And what they're looking for now is, what they're hanging on to now is the hope that things will get better in the future. So the mere fact that we, especially NCR, has been assigned a GCQ status for the rest of the month signals that things probably might be getting better. And so the investors right now are looking more towards value stocks, undervalued stocks. And that is why I think the market is going up despite some bad news happening in the economy.
Robbie, what are investors or traders looking at when they say that the worst is over and it can only get better? Which indicators are you particularly watching?
Well, possibly one of the most important indicators that we can look at is the number of new confirmed cases day by day. So we all know that the pandemic has been one of I think the biggest reason for our dip last March, and that continues to be something that investors are going to monitor. And so as long as we don't see some huge spikes in the number of new confirmed cases every day, it's safe to assume that people think we are in control of the situation, and because of that potential control, they are now more confident that things might be getting better, and they think that is being supported by what the government is doing in terms of opening up the economy. So right now, we just saw that the government is now allowing the opening of non-essential establishments such as gyms, tutorial centers. And
Mhm.
if you were to base your investing decisions on that, you could say that the government might be seeing some improvements in terms of controlling the pandemic, in terms of people now being more willing to go back to the normal to their normal ways, and so it is expected that the economy might improve because of that sentiment from the government and from the general public.
Robbie, can you comment on the PMI figures? What were you expecting? Why another month of contraction compared to the previous month, especially on August, following a rebound that we had already been seeing since June and July?
Well, I think that has more to do with the fact that purchasing managers are a bit cautious because I think that was 1 or 2 weeks ago, NCR and some select areas reverted back to MECQ. So I think they
Mhm.
are being a bit more cautious than usual. They probably think that at any given time, especially when we see another spike in the number of new confirmed cases, things might go back down to those levels. So I think that's something that is being reflected in the PMI, and so we're seeing some apprehension from producers in terms of going back to their normal capacities and going back to their normal output. And I think that's one reason why we saw a dip, despite showing some recovery from May until June.
Can you comment on why properties are rallying here, even as a lot of analysts have been showing a very dim outlook on that? Everyone was hoping that it would get better towards the end of the year, for Christmas holiday season in particular. Are you still bullish on consumption going back to holiday levels, or at least, better than we had seen in the first half of the year? Or are we going to continue seeing more pain for the retailers and the malls?
Well, in terms of retailers matching their previous numbers from last year, I think that's definitely off the table. But we're actually of the view that things are getting better in the property sector, especially in the mall sector. So where we actually saw malls slightly recover with a 50, they increased their gross leasable area to 50 to 70% operational in June, end of June. And that is better than the 30% operational level at back in May. So especially us being here in the mall, we're seeing efforts from mall developers, from mall operators to entice people to come back. We're seeing a slow but steady uptick in foot traffic inside malls. And thankfully, the malls are taking precautions when it comes to enforcing social distancing guidelines. So I think as long as people are seeing efforts by these small operators in terms of protecting and enforcing their safety measures, they might start to feel more comfortable heading back into more public areas, dining out, shopping, and that might bode well for the sales of retailers going into the last quarter of the year. So that's something that we're actually seeing. We're observing it, and we're slightly a bit more bullish than others in terms of the property sector.
Robbie, will these earnings be enough to offset the losses in the first half of the year?
In terms of that, it might be a bit hard to do so. We're of course we're only seeing improvements right now, but these improvements are coming from a what we can consider a low base. So if we compare the improvements being seen this month compared to March or April, it's going to be easy for us to say that things are improving. But if we're going to look back into how things were last year or earlier this year, we might see that things are not as rosy as they were before. And so I think it might be hard for property companies to go back to their previous levels. And I think that's something that investors right now have probably accepted already. And I don't think they're necessarily looking for a return to previous pre-COVID levels, but rather just the mere fact that things are improving from where they were when the ECQ was enforced.
Robbie, you're saying that you're seeing an earnings recovery for two specific stocks, Manila Water and MPIC. Is that on the back of the water concessionaires being, let's say, off the radar, so to speak, of the president's ire? And tell us, or is there something more fundamentally linked in terms of their performance for the next couple of quarters?
Well, in the case of Manila Water, there's actually something more fundamentally linked to their recent good performance. So they reported that June was actually their June volume was actually their highest for the year, and they expect to sustain that momentum for the next few months, or probably until the end of the year. So there has been a pickup in industrial demand for water in July, and they're starting to see as we start to see more establishments reopening their offices, restarting their operations. That will only go to show us that the economy might be moving forward instead of backwards. And I think that's one reason why, coupled with the fact that they were, like you said, taken off the radar recently, I think that's one of the biggest reasons why we've seen a strong move upwards for Manila Water.
Okay, and Robbie, finally, two of your stock picks are still linked in a certain way to consumption. So you've got Century Foods and you've also got Wilcon. Tell us, these two stocks, well, at least Century Foods as well, despite the fact that it was rallying, actually did not necessarily see the same rally that, for instance, Pure Gold had seen after those earnings results. Why is that, especially since this is a food staple? And also finally for Wilcon, why do you feel that investors are bullish on this sector, especially given that construction is still rather limited with the GCQ?
Okay, so in terms of Century Pacific, we like it because it's taking advantage of emerging household behaviors that elevate its demand. So new consumer behaviors are developing. A lot more people are shifting towards products that have longer shelf lives, and that's something that Century Pacific is properly positioned to take advantage of. But in the sense that why has it not gone up the way Pure Gold, the way URC has? It probably has to do with their product offering. So they're not as widely available and widely known as the others, and such as URC. We all know that they cater to the mass market, and so if you're looking for value, if you're looking for efficiency in terms of your costs, your purchasing power, you would likely veer towards the cheaper alternatives. Century caters a bit more to the mid market, the lower end of the mid market, and so that probably has to do with how they performed relatively well, but not as well as some other consumer staples. Despite that, though, we're still seeing resilient earnings and stable margins for them. Now, in the case of Wilcon, I think it also has to do with another emerging behavior of consumers, which is that as consumers are really getting used to staying at home more than usual, they're probably scrapping their plans to travel, to dine out. They're probably opting for staying at home more. They are now shifting the savings that they are getting from those aspects into home improvement. So that's why Wilcon saw improvement in June, and they even posted better revenues in July, mostly because people were now a bit more willing to spend on home renovation, home improvement, and that's something that Wilcon is properly positioned as. And that is being supported by the fact that they have a very aggressive store rollout plan. So I believe they plan to operate 100 stores by 2025. So that's something that is going to be captured as the economy reopens and as we see more people focusing on staying at home instead of going out.
Thank you for those insights, Wilcon, pulling back a touchdown by 1 2/10% at 16 pesos. But nevertheless, as you mentioned, Robbie, it's actually approaching the levels we've seen last year pre-pandemic. Thank you so much for those thoughts. That was Robbie Samson of First Metro Securities.
Thank you.
And that's a first look into the business day. Today is the first trading day of September 2020. Catch us again tomorrow morning, 10 a.m. I'm Danny Laurel, and we are One News.